Welcome back. Three major stories collided overnight. The April PCE report hit the tape at 8:30 a.m. Eastern. Snowflake just booked its single largest post-earnings rally in history, up 38%. Overnight, the US and Iran exchanged fresh strikes. And tonight, Dell reports what could be the defining AI infrastructure print of this earnings season. Let me decode all three and tell you what actually matters.
I'm Daniel Reed. This is Market Lens. Let's start with the PCE report released this morning, the Federal Reserve's preferred inflation gauge. Headline PCE year-over-year came in at 3.8%, the fastest since February 2025, accelerating from 3.5% in March. Month-over-month headline was 0.4%, down from 0.7%. So the monthly pace is decelerating, but base effects push the annual number higher. Core PCE, excluding food and energy, printed at 3.3% year-over-year, in line with consensus, but up from 3.2%. On a monthly basis, core was 0.2%, cooling from 0.3%. That monthly deceleration is the one genuinely positive signal.
Now here is what most headlines will miss. Real personal spending rose just 0.1% month-over-month, down from 0.3%. When you strip out inflation, Americans are spending at the weakest pace since December. That is the first real crack in the consumer resilience narrative that has been supporting risk assets all year. The bottom line? In line, but not soft. Sticky headline inflation at 3.8%, combined with slowing real spending, is textbook stagflationary drift. The Q1 GDP Price Index came in at 4.4% annualized, sharply above Q4's 2.9%. Fed Governor Waller said the next rate move is just as likely to be a hike as a cut. This print changes nothing. The market is pricing 98% probability of a hold at the June FOMC meeting, exactly where it should be.
Now let's talk about last night's earnings.
Because the market is not trading PCE in isolation. It is trading PCE against the single most powerful earnings reaction of 2026. Snowflake surged 38% in extended trading. Q1 revenue hit $1.39 billion, up 33% year-over-year, beating estimates by over 5%. Non-GAAP EPS of 39 cents beat by 22%. Remaining performance obligations hit $9.21 billion, up 38%. Net revenue retention ticked up to 126%. They raised full-year product revenue guidance to $5.84 billion and announced a $6 billion AWS deal. Snowflake went from $175 to $242 overnight, approximately $14 billion added in market cap. Its entire year-to-date loss erased in hours. Why did Snowflake get a 38% rally while Zscaler, which also beat, got a 16% wipeout on Tuesday? The business model. Snowflake is consumption-based. Every AI workload generates revenue. Zscaler is subscription-based with an indirect AI correlation. That distinction is the single most important factor in growth investing right now. Consumption-based AI is being rewarded with massive multiple expansion. Seat-based software is being re-rated downward even on beats.
Salesforce confirmed this.
Revenue of $11.13 billion beat by $80 million. EPS of 3.88 crushed by 24%. Raised full-year guidance. And the stock fell 2%. Why? Q2 revenue guidance of $11.27 to $11.35 billion slightly missed the 11.36 consensus. 2 years ago, that was noise. Today, it is a $5 billion market cap haircut. The market is punishing software companies that cannot prove AI is additive, not cannibalistic. Marvell told the opposite story. Beat revenue, beat EPS. Guided Q2 to $2.7 billion, well above $2.6 billion consensus. Raised FY27 revenue to $11.5 billion and FY28 to $16.5 billion. And the stock fell 3.5%. When a stock is up 130% year-to-date and trading above every analyst target, even exceptional guidance triggers profit-taking. The fundamental story is intact, but the entry point matters.
Now let's look at where we stand heading into today's open.
S&P 500 futures are down 0.14%. NASDAQ 100 futures are down 0.31%. The pre-market softness reflects two forces. First, Iran tensions flared again overnight. Fresh U.S. strikes, Iranian surface-to-air response. Oil is up 2.4%. The peace narrative that drove this market to all-time highs is being tested in real time. Second, the PCE data adds macro caution. Sticky inflation, slowing spending. The VIX is at 17.10, up from 14 last week. Priced for headline risk, not panic. And while Snowflake's 38% move dominates the headlines, the contrast with Marvell tells you exactly where we are in this cycle. A company raises its 2-year revenue outlook by billions, and the stock drops because the entry point was too rich. Now let me give you the framework for Dell tonight. The most important report remaining this week for the AI infrastructure thesis. Dell reports after the close. Street expects revenue of approximately $35.4 billion, up over 50% year over year, and EPS near $2.91, 88% growth. The number that matters? AI server revenue. Dell previously guided approximately $13 billion for Q1, with a total AI backlog of $43 billion. The question is whether management raises the fiscal 2027 AI server forecast above the current $50 billion target. Wells Fargo has suggested it could go as high as $60 to $65 billion. Dell stock is up 136% year to date. Options markets are pricing an 11.75% post-earnings move, more than double the 4.6% average. Expectations are extreme. If Dell beats and raises materially, it confirms the infrastructure build-out has room to run. If it merely meets and maintains, expect a sell-the-news reaction similar to what we saw with Marvell. Snowflake proved AI workloads monetize at the software layer. Dell will tell us whether the server spending is keeping pace. Let me tie this together. 3 forces operating simultaneously. 1. PCE confirms sticky inflation at 3.8% headline, with the consumer showing early fatigue. Growth cooling, inflation not. This keeps the Fed on hold indefinitely. The 10-year at 4.53% reflects that reality. 2. The earnings bifurcation is now extreme. Snowflake up 38%. Marvell down on a massive beat and raise. Salesforce down on a beat. This is not a sector-wide AI trade. It is surgical capital allocation, rewarding consumption-based AI models and punishing seat-based software that cannot prove net new revenue. 3. The geopolitical overlay remains unresolved. Overnight strikes remind us that peace is not priced in, it is hoped for. Oil at $90 is still well below the war spike, but the bounce says risk premium is returning. What does this mean for your trading? First, know what kind of AI exposure you own. Consumption-based data infrastructure and custom silicon have a real tailwind. Seat-based enterprise software needs proof of net new AI revenue, or the multiple will compress further. Second, Dell tonight is a binary event for the AI infrastructure trade. A beat and raise confirms the thesis. A meet and hold triggers profit-taking. Third, PCE at 3.8% with slowing spending is a difficult macro setup for long-duration assets. Growth stocks need accelerating earnings to justify their multiples. Use this framework before every position. The indices are at all-time highs, but underneath, capital is rotating with surgical precision. This is a stock picker's market. The data has never been more important. Keep your data sharp and your logic sharper. I'm Daniel Reed. This has been Market Lens.